where the opportunities also lie. Right now, we're going to have a presentation from Prof. Stiglitz, who is going to provide us with reflections, insights, and contributions from the 3 papers that have been presented here and show some advice to us as well. Thank you.
Thank you very much. It's a real pleasure to be here, especially because of the role of South Africa in the G20 and the opportunity that it affords for rethinking some of the issues of debt. I'm going to discuss some of the ideas that have been are being discussed by this commission. Marina referred to this year being the Jubilee, and the Pontifical Academy of Social Sciences with Pope Francis commissioned this commission to look at the issues of debt. And I'm going to try to summarize some of the ideas. As already been emphasized, this is much a development crisis as a debt crisis. And I'm not going to go over what has already been said, but it is clearly not just that the countries are defaulting on their debt, but they're, as somebody put it, defaulting on development. The issue of over-indebtedness is here again. Many of you may not have been thinking about these issues 25 years ago, but some of us were around when we discussed when there was the HIPC initiative, the highly indebted poor countries, where there, on the occasion of the previous Jubilee, and there was extensive debt forgiveness, and we thought, many thought that would solve the problem. But here we are with a problem of over-indebtedness again. Of course, there were some exceptional circumstances, the pandemic, the Russian invasion of Ukraine, both of which led to high oil and food prices. That was followed by inflation that led to high interest rates. And all of those led to increased indebtedness. But even before the pandemic, many countries were on the road to over-indebtedness. And as we reflect on where we are today, it should be clear that there are some fundamental flaws in the international financial markets. There are some asymmetries, in the global architecture, which disadvantage poor countries. And I just want to second what has been said about the common framework not being up to the task. And when we go to meetings where there are people from the IMF or G20 say, oh, you know, we're moving in the right direction. And that's true, it's the right direction, but at this speed, it won't, it's irrelevant in some sense. So maybe their heart is in the right place, but the pace at which they're moving is just not adequate. And the reforms I'm going to talk about, the actions, are much broader than was just discussed in the common framework, but maybe not as ambitious as was presented in the first one, where we're all supposed to sign up to a human rights perspective. I wish there were solidarity over that, but I'm not optimistic. So I'm going to be looking somewhere between a more aggressive stance than a reform in the common framework and a purely idealistic vision. Among the flaws in the international architecture. One of them has already had attention called to it, and that's the high interest rates. And let me just emphasize that there is some research that shows these interest rates cannot be justified by the default rate. It is well beyond that which can be justified. Of course, if a borrower defaults frequently, you would expect higher interest rates. But capital markets are not working the way that those who believe in markets typically assert. But there's some other problems. The first is that capital flows are pro-cyclical. That is to say, they go into countries in booms and go out of the countries exactly when they need them. And that exacerbates macroeconomic fluctuations in developing countries. And that's part of a broader issue that if you looked at the global financial architecture, it's ironically the developing countries that are in some sense bearing much of the risk. And there's a lot of risk, and much of that risk itself originates from the advanced countries. So we're all experiencing Trump risk. That's clearly a policy risk that originates, but it's not the only time. QE was a risk in global financial markets that originated from advanced countries and had very strong effects on many emerging markets like Brazil. There are climate risks, and historically it is the advanced countries that have contributed to most to climate risk, although today it is the developing countries, emerging markets that have done a lot. And financial risk, example, which was the 2008 financial crisis. And finally, there are commodity price risks that we've done very little to address, and markets haven't done very well in managing those risks. So you have this irony that the developing countries are bearing the risk when it should be the other way around. And finally, there's no adequate mechanisms for debt restructuring akin to bankruptcy courts. And within every country, we recognize that contractual approaches can't resolve the issues of indebtedness. When there's over-indebtedness, we look to a statutory approach, a bankruptcy court, and we haven't created anything akin to that in the international arena. There are a couple of other aspects of the international architecture that contributes to the debt problem I just mentioned very briefly. Being poor doesn't necessarily lead to more indebtedness. If you think you're going to be poor tomorrow, if you were rational, it's not necessarily the case that you would borrow more today. But certainly being poor helps you to get. And a lot of the international framework has facilitated, has made it easier for the countries in Africa to be and remain poor. Escalating tariffs, the overall trade regime, illicit capital flows, the fact that not only small island states have become tax haven, but the United States is a tax haven. And under Trump, we are no longer enforcing the Foreign Corrupt Practices Act. So we want to be an active participant in corruption around the world. More broadly, there are a whole set of problems in the fundamental structures, but there are also a number of deficient institutional arrangements. The most important of which is there are agency problems on both sides. That is to say, lenders are often short-sighted and want to lend. They get their commissions, they get their money up front, and it's somebody else who has to collect it. But also borrowers have the same problem. So, and there have been insufficient efforts to curb. In some ways, the international financial institutions have contributed to the problem because they have de facto bailed out private creditors when they lend too much. And that in doing that, they encourage bad lending. They don't officially call it that, but if you look at the macroeconomic financial flows, what you're seeing right now, for instance, and for the last couple of years, is there has been a large negative capital flow out of developing countries from the private sector. And what finances that? Large capital inflows from the international financial institutions, the MDBs. So indirectly, the international community is giving money to developing countries, which is then giving money back to the private sector. And that has happened repeatedly. They know that, and so they lend, knowing that in one way or another, they'll be helped. The debt restructuring and even assessing the level of debt has become more difficult because there is a much richer set of creditors and associated with the growth of securitization and China coming in as a major creditor. There are a whole set of contingent liabilities that have now grown into the billions of dollars. The worst are the ICSID suits. These are the suits on the investor state suits under investment agreements that are in the billions of dollars. And they are a real worry for going forward. Countries didn't realize they had these liabilities when they signed up for these investment agreements. I have to congratulate South Africa. It took the lead, I think about a number of years ago, in getting out of these agreements. But relatively few countries have followed South Africa's lead. And Brazil has shown that having these agreements does not lead to more private capital flows. So then the credit rating agencies have had outside and perverse effects. The point that was already raised, giving low credit ratings has effectively raised the cost of capital. There's a lot of talking. You'll hear a lot more in the next 3 days about 4 days, and blended finance. The private sector loves blended finance because the more blended is, the lower the interest rates, the more risk assumed by the public sector and the more money they make. So blending has always, like the PPPs, the private-public partnership, has always meant the public sector takes the risk and the private sector gets the gain. So it's a good partnership from the perspective of the private sector, but it means that scarce public money is not being targeted. The contractual provisions, we'll call collective action clauses. Many people back in 10 years ago thought they were going to solve the problem. There clearly were, again, a step in the right direction, like the common framework, but clearly not enough to address the debt problem. And there's a problem that has become apparent in some of the cases in debt restructuring. When you have people entering the bargaining room, the creditors enter the bargaining room, lack of transparency means you don't even know whether their creditor's interest is in having a default. And that's because of the growth of derivatives and credit default swaps, which mean that the creditors may have divested themselves of all of the risk, and yet they still have voice. And there is no process for transparency to make sure that they even have skin in the game, or at least skin in the game that reflects their bargaining power inside the room. So I'm going to talk about now some ideas that we are discussing for resolving current debt crises. Steps forward that we think that would be step forward. It's not a complete list, but it's at least some. One is there need to be common principles, and I think the idea of that was discussed of bargaining together when there are enough commonality, it makes a lot of sense. It's like class action in lots of other categories. But in many cases, there are big differences among countries, and you will have to have country-specific bargaining, but try to refer to common principles. There were a set of common principles, and I appreciate the reference to the principles that were adopted by the UN almost unanimously. It just so happened that I think there were 6 countries that voted against, happened to be the 6 important creditor countries. And so, but there are principles which I think everybody would agree to behind a Rawlsian veil of ignorance. It was only that special interest clouded the view. The second one is no more net transfers out of debt distressed countries, and avoiding the bailouts by the international financial institution. This is the point I just made, that we've been financing. The international financial institutions have been giving money to countries to pay the private creditors. There's an important point here related to the distinction or the difficulty making the distinction between illiquidity and insolvency. And that is the following. In principle, a country that is illiquid and could get financing at reasonable terms would be able to repay the debt. Now, obviously, if everybody believed that, and capital markets work perfectly, then somebody would lend and the liquidity problem would not be there. So there's a close link between illiquidity and insolvency. But some people have calculated, done the following calculation. They said, if the private creditors were willing to lend at reasonable interest rates, an interest rate the World Bank lends at plus a little bit extra, would these countries be solvent? Would they be able to make their debt payments? And the answer is, for a vast majority of the countries that are in distress, they could make those payments. So in other words, a reprofiling in which the private creditors recognized that there was a reprofiling which restored them to debt sustainability and therefore lowered the interest rate would work. The unfortunate thing is the private creditors are never willing to lower the interest rates. They want debt sustainability, and they want high interest rates. And they also believe that markets work perfectly. So you square that circle and you can get a Nobel Prize. So the point is that if there were good faith bargaining, I think a lot of the problems could be resolved, but I don't see that anytime soon. The third point is put in there strongly by some people from Argentina, which is in politically motivated lending. You may have noticed that Argentina, who owes $44 billion and not able to repay that $44 billion, just got a massive, was it $22 billion from the IMF. Now, that's a lot of money, and obviously Zambia would have liked that. A lot of other countries would have liked it and would have solved all of Africa's problems, I think. Why did it get that money? Well, we all know the answer. It was politically motivated lending. But the IMF denies that. One way of dealing with this is ensuring lending and debt restructurings are transparent and have broad societal support. And one way of doing that is to make sure that they are ratified by Parliament. It doesn't ensure it, but at least increases the likelihood. For those who are countries that are deeply restructured, there has to be deep principal reductions. And for other countries, long extensions of maturity and a reduction of interest rates. This entails extending and expanding debt suspension initiatives. One critical piece in debt restructuring is assessing what does it mean for debt to be sustainable. And that's supposed to be a technical exercise, but it turns out it's a technical exercise with a lot of assumptions, and those assumptions may have non-technical aspects to them. I've just listed a few aspects of that. For one is to recognize that the nature, the depth of the debt restructuring affects growth. Growth affects what can be repaid and whether debt is sustainable. So often growth projections are made independent of the debt decisions, and you can't do that. Similarly, climate vulnerability is part of the risk, particularly if you're a small island state. And if you're doing debt sustainability, you have to include climate. One of the aspects of debt sustainability has to be, in one way or another, as I say, taking into account growth dynamics. And one of the things we should have learned is extreme austerity, which has been a part of a lot of the programs, do just the opposite. And so what we saw in country after country, that didn't work. Not only in developing countries, but in Greece, for instance. People in Europe are cheering that Greece is finally, 15 years after the crisis, getting back to its per capita income that it had 15 years ago. I don't know if I call that a success. And its per capita income, and much of it still owes a lot of money to foreigners, so that standards of living are actually lower, health is lower, and so forth. Let me go through just a few of the other important points. Establishing a fund for the repurchase of debt. And that was sort of one of the points that was just mentioned. One of the easy ways of reducing debt burden is to purchase bonds that are selling for 30 cents or 20 cents on the dollar. You can't announce that you're going to buy all the debt, because then the price will go up, but it can make a dent in the amount of debt that's outstanding. There are some broader reforms of the multilateral lending and financial system that a lot have been talked about. I won't talk about any except the last one, that the institutional environment affects debt sustainability. And one aspect of the institutional environment is the regulations for capital outflows. And so, for instance, one of the things that happened in the earlier politically motivated loan from the IMF to Argentina and the Macri government is they made a decision to allow an outflow of money. And what did that do? It meant that all the wealthy people in Argentina took the money and used it to take money out of the country. And then, of course, the exchange rate eventually fell. So the IMF had actually funded the outflow of money, leaving Argentina with $44 billion of debt and leaving the wealthy people in Argentina much wealthier with their money abroad. Well, amazingly, the IMF celebrated that they had done just the same thing in this new loan. They obviously haven't learned the lesson, even after they had a report from their own institutional oversight talking about how they had made mistakes before. This is something that we've been working on in New York State, and people in London have been working on. A very large fraction of all the loans go from UK and New York State. And there are three key ideas. One is curbing predatory litigation by vulture funds. For those you know, technically it's called the Champerty provision. It's very likely that we'll get a provision on that. The second one is they pay 9% interest on what's called prejudgment interest until there's a resolution. There's a 9% interest rate on debt outstanding, interest outstanding. And of course, with that interest rate, that's more than you can get on any other investment. So why would anybody resolve a debt? It's the best investment you can have is to draw out the litigation. And the final thing is comparability of treatment. The private sector often drags its feet, hoping the public sector will make a debt agreement, and then they will take advantage of that. And so there's a provision that being discussed, may not go through this year, on comparability of treatment, that the private sector can't get any better terms than the public sector. Let me go on to some big reforms that I think are really important. One is creating international bankruptcy court. The second is better macroeconomic coordination, with the dominant countries taking into account the externalities they impose on smaller countries. The central banks in the United States and Europe set the global interest rates without taking into any account the effects on other countries. The third is commodity price stabilization schemes, or at least better risk-sharing mechanism, because one of the problems of facing, as I mentioned in the beginning, facing developing countries is that right now they bear disproportionate risk. The fourth is something that's really important, is more extensive use of special drawing rights. Special drawing rights are the money that the IMF can create. It can be used in very many different ways to stimulate global aggregate demand, to finance climate investment, to help finance buybacks of debt. That was used, $600 billion issuance was used during the pandemic. It wasn't optimally used, but it was still of enormous benefit. And finally, I think reconsidering odious lending That odious lending is lending the country that lenders shouldn't be made loans that shouldn't be made like to corrupt dictators that democratic governments then have to repay. And that would at least curb agency problems from the lender side. So a few just concluding comments. In the absence of a global legal framework, the possibility of just debt resolution depends in large part on the will of the most powerful to act with solidarity. If we do reform the system itself, we will continue to reproduce. If we do not reform the system, we will continue to reproduce the very dynamics that led us here. The international financial architecture must be redesigned, not only to enable just and efficient debt resolutions, but to create sustained access to financing needed for inclusive growth, climate, and structural transformation. But let me say, it's not just access to debt. Part of the problem, what we're seeing is over-indebtedness or not debt going in the right way to the right place. Final 2 points, debt is only one pillar of a global economic order that has become fragmented, extractive, and inequitable. If we are to achieve lasting peace and shared prosperity, we must reform the entire architecture of the global economy, its rules for taxation, for trade, and for the creation and diffusion of knowledge. Thank you.